Hello, this is Dr. Malorani. Welcome to the week of April 6th. I hope you're staying safe and everything is going well for you and your family and friends. I'm confident together we'll get through this. And if you have any questions or problems about the course materials or other matters at MCPH University, please email me and I'll do everything I can to support you. This week we're going to focus on money and banking. In addition, I've added a special topic focused on the financial crisis and Great Recession that started in 2009. So this week, what we want to do is the same that we're going to do every week, which is first to review the posted materials and videos. So I've posted materials on money and banking, both some PowerPoints and a few videos. And then I've posted a folder here on the financial crisis, part 1. So we'll be looking at this for a couple of weeks. The first part will be to look at what the financial crisis was and what may have caused it. So when you're done with those, reviewing those materials, what I'd like you to do is first participate in the discussion board. So there's 2 questions I've posed. What was the financial crisis? And what are some of the root causes of the financial crisis? As I said, we'll continue to review this topic for the next couple of weeks. Next week, we'll look at the response to the financial crisis, and then we'll look at the impact to individuals. There's also a graded assignment, and the graded assignment is on money and banking, which is chapter 14. And I've broken up chapter 14 into 2 sections. So I'm just going to focus on money and banking this semester. Next semester, we'll look at, next week, we'll look at the Federal Reserve Bank. So let's get started in looking at money and banking. Okay, money, banking, and the Federal Reserve System is chapter 14. As I mentioned, I've broken this up into 2 weeks. So this week, we're just going to look at the money and banking portion. Next week, we'll look at the Federal Reserve System. So we want to understand what is money, how does it derive its value, where does it come from, how is it different than wealth, and who controls the money, the supply of money, how is money created. Those are going to be the key things we're going to look at in this week's lecture. So money is basically anything that we use to exchange goods and services. So people have used many different things through the years, ranging from clamshells to other objects. And so money's been around for a long period of time. So what we have today really is something called a fiat money. Fiat money is money that is created by the government, and we use it really for 3 main purposes. It's a medium of exchange, a unit of account, and a store of value. And so when you look at the graded assignment, which by the way, you can take multiple times and your highest score will be counted, these are going to be some of the basic questions I'm going to ask. So the money supply is the total value of financial assets in the economy that are considered money. If we were doing this in a more in-depth economics, let's say we were majoring in economics, we'd talk about M1 and M2 and M3 and all those things. But for our purposes, we're going to keep this at a fairly high level. And we're going to think about money as essentially currency in circulation and checkable bank deposits. Basically accounts that people can write checks on. So when we think about that, the total value that we have in the US economy is about 1.3 trillion. And that may be increasing with the COVID crisis that we're incurring at this point. But $1.3 trillion of currency and checking accounts, and that really supports a much larger economy. That supports an economy in the US about 20 trillion. And the way that happens is essentially is how money gets created. So when we put money into the banking system through the Federal Reserve Bank, it gets loaned. They in turn deposit in commercial banks, who then loan it out to individuals and firms, and there's a multiplier effect that expands the use of this $1.3 trillion to support our $20 trillion economy. So one thing, one of the reasons I put this chart here is to show that there was a dramatic increase in the base currency that occurred in 2008, 2009. So we had been running at about 800 billion, and then that was increased to over 1.3 trillion. And that was in response to the financial crisis and Great Recession that we lived through and starting in 2009. And the Federal Reserve put more money into the banking system to basically create more liquidity, to make funds more available to consumers, to firms, and others to keep the economy going. We'll probably see something similar to the COVID public health crisis, which is certainly going to be an economic crisis as well. But I think right now it's a little too early to tell how much additional currency will come into the U.S. economy as a result of trying to encourage firms and individuals to become active in the economy. And so the more currency we put into the system, the less expensive the currency becomes to acquire. So interest rates go down, and it makes it easier for people to acquire money, and banks are incented to loan it out as we increase the base amount of currency in the system. So we'll see what happens in response to the COVID and public health crisis, but certainly in response to the financial crisis of 2008, there was a dramatic and unprecedented increase in money put into the economy. So one thing that we should understand is that we have currency, we have bills and coins and checking accounts that, let's say, is worth 1.3 trillion. The economy is about 20 trillion, so 18 or so times the amount of currency we have. And the estimated wealth of the United States, of Americans, is about 100 trillion. And what happened in the financial crisis is that we peaked out about 70 trillion, and there was a dramatic drop in people's wealth. And so you might ask, well, how did that happen? Where did all this wealth go? And so wealth really is a perception of value. So if you think about where most Americans' wealth is, it's really in two areas: the value of their homes and the value of the stock market. And so during financial crises, during financial downturns, what we see is the value of those things tends to go down. So you might ask, well, why is the value so high? And so the value of those things becomes high because people's expectations about the future. So if I expect the value of my house to go up, then that by nature increases the value of it. If I expect companies to continue to produce profit and increase sales, then that increases the value of stock in the stock market. And when the reverse happens, then the perception of the future value declines. And so so this chart goes back to 2011, but if I were to put a chart up that showed through 2020, we'd probably see this go back up to about 100 trillion. And it's certainly going to take a hit during this COVID crisis, which we hope will be a short-term crisis. We hope that there'll be a treatment for the virus. We hope that there'll be a vaccination, and I'm sure there will be. It's just a question of how long it's going to take for us to figure those things out. So here's a little bit more on the wealth issue. So what you can see is that the dip occurs here. This is 2008, 2009, and then it accelerates back up. And if I would extend this out to 2020, we'd see it well over 100 trillion. But if we look right now, it's probably on the downside, right? And how steep and how far it's going to fall is to be seen. But we're definitely going to take at least a short-term hit in terms of the perception of the value of homes, stocks, and other things. And hopefully it's a short-term situation. So the next question is, who creates money? So it really is a multi-step process. So let me just outline what happened. So the U.S. Treasury, which is part of the federal government, mints new currency. So they print the money, mint the coins, and then they give it to the Federal Reserve Bank, which is the central banking system of the United States, to distribute or destroy the currency. But we'll just talk about distributing the currency. So that it's given to the Federal Reserve Bank. they in turn loan it out to the large commercial banks. And so large banks buy the currency by exchanging treasury notes or by taking a loan, and now they have lots of currency on hand. And then banks have to make a profit, have to stay in business, so they loan that out to consumers and to firms. And that's how money is created. So it's a multi-step process. The US government plays a role, the central banking system plays a role, commercial banks play a role, and then we as individuals or firms also play a role in expanding the money. And money, so if that 1.3 trillion really can support a much larger economy, and that's basically because of the multiplier effect, which we've talked about. So as I mentioned, 1.3 trillion in currency supports a GDP of 20 plus trillion, and the perceived net worth or wealth of individuals and firms across the United States of about 100 trillion. So here's another picture of how things get created. Just keep in mind it's a multi-step process. Another little picture here that kind of illustrates the multiplier effect, right? So somebody puts 100 units in, the bank has a reserve requirement of 10%, they loan out 90, goes to the next bank, and they loan out 90% of that, and so that 100 actually multiplies by a factor of 10. So banks and other financial institutions really play a critical role in this whole process. They're the financial intermediaries. They allow assets, cash to be accessed, or they allow for liquidity. They also provide opportunity for people who have excess cash to deposit it. And so it's a very efficient process. So rather than you and I searching around to find a automobile or student loan, we know that we can go to a bank or other financial institution and they'll have the funds available for us to access. So without this financial intermediary, we'd have to find an individual who had excess cash, and that would be very inefficient. So banks are a key part of the financial stability of any economy, because they ensure the liquidity process, the credit access to credit and liquidity that is so vital to any economy. Yeah, so the primary purpose of financial markets and institutions is to act as a bridge between lenders and borrowers. By accepting deposits and making loans, banks and other financial institutions are also able to create money, right? So, and that's the whole multiplier effect. So when you deposit money in a bank account, the bank only holds a portion of that. That's called a fractional reserve system, which we'll look at in a little more detail when we look at the Federal Reserve Bank. But they're only going to hold typically about 10% of that, and they'll loan out the rest. And that's how money gets created. So we need the banking and financial system to be very stable. So we need them to be conservative, to make rational judgments about who gets money, access to money, because it has to be repaid to ensure that the financial stability of the company, of the banks are there. So one of the things that we do is we offer FDIC insurance, Federal Deposit Insurance Corporation. So that gives depositors confidence that their money will be there. And we also hold banks to other capital requirements that are beyond our discussion at this point. But banks are highly regulated and are expected to be very prudent in their approach so that they can maintain the financial stability of the markets that so many of us rely upon every day. Without that, there used to be this thing called a run on the banks, right? People panicked. They heard that people couldn't get money out of their bank. And so we've put laws and regulations in place to try to allay that fear, right? So deposit insurance, capital requirements of banks, reserve requirements, and there's also the lender of last resort, which is the Federal Reserve Bank, if everything else fails, right? So that people can have confidence that their money is safe and secure when they put it in these financial institutions. So essentially what happens is the banks take their excess reserves that 90% of the deposits and they loan it out. And then the hypothesis is that there's a money multiplier, and the money multiplier is based on the propensity to save versus the propensity to consume. And so hypothetically, if the propensity to save is 5% and the propensity to consume is 95%, you'd have a multiplier of 20. But essentially, that is the way that money gets created in the economy. So it's that initial minting by the US government goes into the Federal Reserve System. They place it into large commercial banks who then loan it out to individuals, banks, and so forth. And then under the fractional reserve system, it gets multiplied many times over. Okay, so let's take a look at what the special topic of the week is. So in the week of April 6th folder, you'll see something called the Financial Crisis Part 1. In here, I've posted some a brief PowerPoint slide, which I'll go over in a couple of minutes, and also 3 videos, all of which I would like you to watch. They're all very well done, relatively short, and will give you some really good insight as to where the financial crisis started, why it started, and as I said, in the upcoming weeks, we'll look at the response to the financial crisis and then the impact to individuals. Okay, so what caused the 2008 financial crisis, which in turn caused the Great Recession of 2009 through 2011? So first, we have to ask the question about housing, because housing was at the base, the foundation of what happened to the financial crisis of 2008. So the first question is, why did housing prices rise rapidly and then fall? And why did the mortgage default and housing foreclosure rates begin to increase more than the year before the recession of 2008 started? And why were the default and foreclosure rates so much higher than any other time in recent history? And maybe most importantly, why did these very savvy and long-standing investment firms like Bears Stearns and Lehman Brothers invest in these risky financial instruments and run into financial difficulty? And then what did the policymakers do to respond to the financial crisis? We won't get into that till next week. And then what have we learned? So hopefully, as we go through another crisis right now that we're living through with the COVID public health crisis, we've learned how to be more responsive in a faster and more efficient fashion. So possible causes: loose monetary policy, low interest rates. Okay, so we had low interest rate. We deregulated some of the banking and financial instruments. We had new, complex, innovative financial products. Some people call this the model that ate the economy. We basically, in the early 2000s, mortgages were very easy to get. Housing prices were going up. Everybody wanted in, and it became just a mess. And so we created these subprime mortgages, which were basically mortgages given to people who ordinarily would not have qualified for mortgages. The rating agencies pretty much rubber stamped them as being AAA. And then there's the issue of greed versus fear. Our economy depends on a balance between greed and fear. And that's called the negative feedback loop. The negative feedback loop is that as prices go up, usually you'll see less buyers come into the market. And that kind of keeps prices in check. But in some cases, when prices go up, more people come into the market. You see that in the stock market sometimes, you see it in the housing market sometimes. And economists call that chasing lemons. And eventually that can lead to big bubbles, and big bubbles eventually burst. And that's what happened in the 2008-2009 financial crisis. So loose monetary policy. So Alan Greenspan lowered interest rates to 1% in 2003. And Money was easy to get, and banks were anxious to lend it out. We deregulated the financial instruments, so the Glass-Steagall Act of 1933 that separated commercial banking from investment banking was pretty much done away with, and it became much easier for anybody to offer these mortgage-backed securities and get into the housing market. And so that became something, we created a shadow banking system. And there was a whole bunch of new financial products that, frankly, Warren Buffett called the financial weapons of mass destruction. Many people were buying them, not really understand. And these, I'm not talking about average consumers like you and I'm talking about savvy financial institutions were buying them and not really understanding what was behind them. So these ideas of mortgage-backed securities and credit default swaps, all of which is beyond our in-depth understanding of. I just want you to get a general flavor as to what's going on in terms of the economy in 2005, 6, 7 that leads up to the financial crisis of 2008. And then we have this housing boom. We have this unprecedented increase in housing prices. So more people, as people see prices going up, they want to, rather than buying less, they want to get in because we're afraid they'll never get into the housing market. And there's a very famous economist, his name is Schiller, he's at Yale, who focuses on the housing market in the US. And what this chart is 1890 to 1990. And basically what he found is that if you bought real estate in 1890 and held on to it for 100 years, you basically would keep up with inflation. And then all of a sudden we saw this spike up. And this was a bubble. Okay, so this massive increase over this 5-year period, and then the big collapse. Foreclosures started to fall, housing prices fell, default rates went up, and part of the blame here is the role of the credit rating agencies, who are supposed to carefully assess these mortgage-backed securities, and they were basically rubber stamping anything that lenders wanted to do. And then, not to be ignored, is that the individuals figured that they could make money. Firms and individuals figured, I'll jump into this market even though I may not understand it, even though I know it's risky, because everybody's making money. So people were more greedy and less fearful, and that got out of balance, and that exacerbated the problem. So if you'll watch those 3 videos I've posted, then once you're done with that, I'd like you to participate in the discussion board. So this is part 1 of the financial crisis, so we get a basic understanding of it. And then next week we're going to look at 2 things: the financial crisis part 2, which is the response to this by the Federal Reserve System and the U.S. government, and we'll also look at we're also going to look at the impact of the 2 individuals. Okay, so what I'd like you to do this week is, after you've reviewed the materials, participate in the discussion board question, your initial post by 11 o'clock on Thursday, answering these 2 questions. Respond to 1 or more of your colleagues by Sunday, and to complete the graded assignment on money and banking. So the thing about the graded assignments is that you can get as high a score as you want, because you can take it multiple times and your highest score will count. Okay, so I hope you are safe and remain safe. If there's anything I can do for you with regard to this course, the university, I'm happy to be of service to you.